Gold just broke the market's safety lock. This wasn't a breakout, it was a rupture. Gold didn't climb past resistance, it smashed straight through it, surging above $4,700 an ounce globally. In India, it crossed 1.52 lakh per 10 grams, a 63% gain in a single year, the strongest run since 1979. Markets do not move like this unless something underneath them is failing. And here's the contradiction. This is happening while the system is still telling you everything is fine, inflation is contained, growth is stable, yet silver just jumped more than 5% in one session, ripping past $94 globally and 3 lakh rupees per kilo in India, 70,000 rupees in 11 trading days. That speed isn't optimism, it's fear moving faster than explanations. If you hold cash, earn a salary, or plan for the future, this isn't a headline, it's a warning. Because when money reprices this violently, it quietly rewrites what your savings are worth. But here's the part nobody is focusing on. While prices explode on screens, the real market underneath is starting to malfunction. And once you see where that stress is leaking out, this rally stops looking bullish and starts looking dangerous. Here's where the story actually starts to take shape. What you're watching isn't a random surge in metals. It's a reaction. And the trigger wasn't hidden in some technical chart. It was loud, public, and political. The rally accelerated after the United States threatened a 200% tariff on France, with similar pressure aimed at Germany and the UK tied to disputes over Greenland. That's not routine trade friction. That's economic force aimed at allies. Notice the pattern. When trade turns into a weapon, markets don't wait for policy details. They price in uncertainty immediately. Investors aren't asking whether tariffs will happen. They're asking what comes next if they do. And that question alone is enough to push capital out of paper promises and into assets that don't rely on political goodwill. But here's the reframing question most coverage skips. If one announcement can trigger this much movement, what does that say about the stability that was supposedly already there? This isn't about gold being strong, it's about confidence being thin. And once confidence cracks at the geopolitical level, the stress doesn't stay there for long. It travels. The claim being made by the market right now is blunt. This rally isn't being driven by enthusiasm, it's being driven by fear of policy chaos. And the evidence shows up where most people aren't looking. Here's a concrete detail from inside the system. Refiners are delaying payments to dealers by 7 to 10 days. That's not normal. That's a sign of liquidity stress. Even more telling, some refiners are offering to buy silver at $15 below spot price. Let that sink in. Screens are showing record highs, but the physical market is quietly saying, we don't want the risk. This matters because it exposes a split personality in the market. On paper, silver looks unstoppable. In reality, the plumbing is clogging. Intermediaries are refusing inventory exposure because prices are moving too fast to hedge. That's not bullish confidence, that's defensive behavior. Now notice what's missing from the headlines. Nobody is talking about why a soaring market would refuse to clear trades at spot. Nobody is explaining why liquidity is disappearing precisely when prices should be attracting sellers. This is where the story flips. Because when price discovery breaks down at the physical level, the screen price stops telling the full truth. And once that disconnect starts, the next phase of this rally looks very different. Now watch how fast this escalates. Once the physical side starts wobbling, behavior changes everywhere else. What should be a rare stress signal begins to feel normal. Dealers stop acting like sellers and start acting like risk managers. Payment delays become routine, buyback discounts widen, the system adapts to instability instead of fixing it. We've seen this pattern before, not in precious metals specifically, but in moments where markets stop trusting their own mechanics. When volatility becomes the baseline, everyone protects themselves first, and that protection shows up as friction, slower settlements, tighter terms, quiet refusals to take risk. Here's why that matters. None of this triggers headlines. There's no emergency announcement, no official warning from the outside. Everything still looks functional. Prices are up, charts look strong, commentators call it a rally. But underneath, behavior is shifting from participation to preservation. This is how abnormal conditions get normalized. What should feel alarming starts to feel routine. And once that happens, pressure doesn't release, it builds. Because when a market keeps moving higher while its internal systems quietly pull back, the question stops being how high can it go. The question becomes how much strain it can absorb before something gives. Here's the evidence that changes how you see the entire move. While prices are screaming buy, the people closest to the metal are quietly doing the opposite. Retail demand has gone vertical. Dealers are reporting one of the highest order weeks in their history, with volumes jumping 40% week over week. Some buyers are even liquidating retirement accounts just to get exposure to silver. That's not strategy, that's urgency crossing into desperation. And yet, at the same time, major dealers are putting up barriers. Minimum order sizes are rising, buybacks are being restricted. When a company built to sell metal starts rationing access, something is wrong. This isn't about popularity, it's about capacity being overwhelmed. Notice the contradiction. Public messaging says demand proves confidence, but operational behavior says risk is being capped. The system is saying yes with words and no with actions. Here's why that detail changes everything. A rally driven by steady allocation welcomes sellers. A rally driven by fear tries to control flow. When access itself becomes scarce, price stops being just a signal and starts becoming a pressure point. And once pressure replaces confidence, the next phase isn't smooth continuation. It's instability. And this is where the situation starts to feel less like a rally and more like a system losing grip. First, dealers aren't just busy, they're rationing. Minimum order sizes jump to $500 online. Buybacks suddenly require $10,000 just to participate. That's not marketing, that's triage. When demand surges 40 to 50% and infrastructure can't keep up, access gets gated. Second, pricing friction spreads. Refiners slow settlements. Dealers hesitate to restock. Inventory doesn't flow smoothly from seller to buyer anymore. Every step adds delay, cost, or restriction. Each one is small on its own. Together they compound. Third, behavior accelerates. Buyers rush harder when they sense limits. Sellers pull back when volatility spikes. The market feeds on its own stress. Nobody wants to be last. This is what loss of control looks like in real time. No single collapse, just mounting pressure across multiple points at once. Speed replaces planning. Reaction replaces strategy. And here's the question that now hangs over everything. What happens if this doesn't cool off? What happens if the pressure keeps stacking instead of releasing? At this point, the story stops being about charts and starts being about you. Because when markets behave like this, the impact doesn't stay on trading screens. It shows up in everyday decisions. Prices move faster than paychecks. Savings feel smaller without anything being spent. Big purchases get delayed. Plans feel less certain, not because something has happened yet, but because trust in stability is eroding. Think about what it means when people empty retirement accounts to buy silver. That's not speculation. That's fear of standing still. It's the sense that holding cash is the risk, not the hedge. And when that mindset spreads, it changes behavior everywhere. People rush, they overpay, they accept worse terms just to feel positioned. Notice how quiet this part of the story is. There are no speeches about it, no official warnings, but you feel it when access gets harder and rules change overnight, when something you could buy yesterday suddenly requires a minimum or a delay or a premium. If this feels familiar, say so in the comments. Because when ordinary people start adjusting their lives around market stress, the situation has already moved beyond theory. This is where you have to step back and look at the machinery, not the emotion. Markets don't move like this just because people get nervous. They move like this when incentives line up in a dangerous way. When policy becomes unpredictable, when debt keeps expanding, and when trust in long-term promises weakens, capital doesn't debate. It migrates fast toward whatever feels least exposed to someone else's decision. That's the mechanism at work here. Gold and silver aren't rising because they're exciting. They're rising because they sit outside the system that's generating the stress. No counterparty, no policy committee, no overnight rule change. And once that realization spreads, even slightly, it creates outsized effects because these markets are small compared to the ocean of money sitting in bonds and cash. Here's the unsettling insight. Gold still makes up a fraction of a percent of major investment portfolios. Silver even less. That means you don't need a stampede to move prices. You just need a drift, a slow reallocation, a few large players deciding that stability matters more than yield. And once that shift starts, it doesn't announce itself. It just keeps going, quietly pulling pressure forward. Now the question stops being why this happened and becomes where it's headed. From here, there are two paths, and neither is clean. One possibility is release. Tensions cool, policy threats soften, volatility bleeds off. In that scenario, prices don't collapse overnight, but they don't sprint either. Silver especially could snap back hard. 30% moves aren't extreme when something has tripled this fast. Gold could retrace without breaking the bigger trend. That's the path where pressure exhales. But there's another path, and the market is clearly hedging for it. Escalation without resolution. More policy shocks, more uncertainty layered on top of debt that never really gets addressed. In that world, capital doesn't rotate back, it digs in. Every pullback gets bought, not because it's cheap, but because alternatives feel worse. Notice the tension. The rally looks stretched. Risk is obvious, and yet participation keeps widening. That's usually a sign that the next move isn't a decision. It's momentum already in motion. Something is forming ahead of the headlines. The only question is which path locks in first. Here's the insight that ties all of this together. This wasn't a story about gold getting stronger. It was a story about confidence getting weaker. Prices didn't explode because metals changed. They exploded because the system around them started sending mixed signals, and money hates confusion more than anything else. When markets move this fast, the mistake is focusing on the numbers instead of the message. The message is that stability is being repriced in real time, quietly, unevenly, and once that process starts, it rarely ends where it began. What happens next won't be decided by charts alone. It will be decided by whether uncertainty retreats or embeds itself deeper into policy, trade, and trust. This isn't the end of the story. It's the opening chapter of a longer shift that most people won't notice until it's already reshaped their choices. If you want clear, calm analysis as this unfolds, follow and subscribe. We'll stay ahead of the next move.